The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick and Juliana Tattelbaum. These are your headlines. Donald Trump's tour of the Middle East continues as the president helps Boeing land a record deal from Qatar Airways before heading to the UAE this afternoon.
Well, shares in trading platform Etoro spike on their Nasdaq debut, potentially heralding a reset in IPO sentiment stateside.
And Siemens backs its full-year outlook after beating expectations in the second quarter as CEO Roland Busch tells CNBC tariff deals will have a positive impact.
We hope that with agreements on tariffs to come to normal agreements where companies can work with, that this would basically then support a normal growth rate going forward.
Right, by and large, I can tell you the UK GDP figures, which have just hit the wires, are at the top end of expectations, but there are a couple of banana skins in there. There's always a caveat when it comes to UK. Good morning, Karen. Good morning, Juliana. Let me just pile through a lot of data. Okay, so March GDP in the latest month-on-month figure was better than expected, up 0.2%. We were looking for flat growth on that one as well. The 3-month-on-3-month figure, again, at the top end of expectations, although within the range of expectations, up, as you can see on the screen, the team have done a great job getting it there already, up 0.7%. Right, now I'll move on. Industrial output, a little bit better than expected, negative 0.7%. Reuters was going for negative 0.9%. The banana skin is coming from manufacturing, negative 0.8%. The Reuters poll was looking for negative 0.5%. I'm going to just pile through a couple more of these because construction, way better than expected. A real standout there, up 0.5% month on month versus the poll of 0.1%. Services was better. Construction output, I mentioned that one as well. So by and large, manufacturing is the banana skin. Industrial output was better. Services was better across the board. And my goodness me, ladies and gentlemen, did you see that retail sales figure we had in the last 24 hours? Blockbuster. When the sun's out, the Brits get their wallets out, or digital e-payment system, or whatever they used as well. Do you want the trade balance figures? They're actually slightly better. The March goods trade balance was only negative 19.869 billion versus a revised negative 20.964 in February. Okay, so that's the data. The pound mildly high on the back of it. Nothing too much to move the needle. But my goodness me, we've been speaking to some interesting people about this.
We certainly have. Now, this data covers a period where tariff uncertainty and on-the-hoof trade policy roiled global markets. As Steve said, we spoke to key members of the Bank of England, past and present, and got their views.
I need to see the loss of pricing power. I need to see that firms are starting to be much more moderate in setting their prices across a broad range of products.
We've got pressure again for strikes by some of the doctors, some of the public sector workers. We can't afford that. Wages have already gone up because of the minimum wage that's gone up. So we are in a very delicate position, I think, in the labor market.
It's quite natural for companies to say, look, making an investment is a one-off decision. I can't reverse it once I've committed, as it were. Therefore, if I perceive greater uncertainty and I'm more doubtful, I'll delay the decision. That's absolutely natural. And by the way, when I go around the country, and I do, I am hearing more of that. I have to tell you, I am hearing more of that.
We were just saying to our next guest how impressed we were with all the detail that Catherine Mann gave us yesterday. I hope you were watching. Well, a man who's going to give us just as much detail on the UK economy is Andrew Wishart, who is the senior UK economist at Berenberg. Andrew, I don't know if you heard me going through all the numbers. By and large, better than expecting. Manufacturing suitably downbeat. Construction upbeat. Services pretty much better than expected as well. And we had the consumer doing what the British consumer does, which is throwing caution to the wind in the sunshine yesterday. What do you think, sir?
Yeah, I think we expected the GDP data to be a little bit stronger with this 0.7% Q-on-Q in the first quarter. I think a lot of people write this off as extreme seasonal volatility, and there is, there's some truth to that. But ultimately, when we take a step back and look at annual growth to abstract from that ups and downs from quarter to quarter, we're seeing the economy growing at 1.2%, 1.4%-ish year on year. That's the best growth rate we've seen for a couple of years, and I think it shows the economy getting back to a more normal pace of growth. Now we've come through the energy price inflation shock, we've come through the interest rate shock, and hopefully this is the UK economy putting that really weak period behind it.
There are so many $64,000 questions, but I'm going to ask you one of them, and that is a question I've asked Mr. Bailey and Catherine Mann in the last week. Are we seeing any evidence that the government's growth agenda, growth being the number one priority, and by the way, there's a brilliant piece from Janan Ganesh in the FT today about whether growth is the priority, and I love that piece, so full credit to that FT columnist as well. Are we seeing any evidence yet that the Keynesian push from this government is beginning to bear fruit?
Well, I think it's certainly supporting demand. We know, and I haven't seen the data today, but I imagine government consumption was strong again. So in the near term, it's definitely supporting demand. In the long term, growth really is about what you do on the supply side. I think the government really needs to probably step away from trying to tax and spend. The tax burden is pretty high now. Instead, I think it really needs to refocus on taking away the biggest risk to the UK economy, which is the deficit that's just not coming down. That's the thing people are worried about. And putting that spending into the economy is also preventing interest rates falling as fast. So, we're supporting demand with government spending. If that wasn't the case, we'd probably have lower inflation. We'd probably be able to support demand with interest rate cuts instead. So I think a bit of a pivot, hopefully in the autumn budget, would be the right thing. And that by taking away one of the big risks of the UK economy, which is the tough fiscal situation, I think that could be one of the best things the government could do actually for growth.
Yesterday, one of the most interesting things that Catherine Mann shared with us was around the difference between price inflation at the dock and price inflation on the shelf. And she said that she doesn't necessarily think that trade diversion from China is going to be disinflationary for the UK economy, because she thinks companies are going to try to rebuild margins, use this as an opportunity. Do you think that she's right in that?
Yeah, I think she is right, absolutely. So, we do know that falling global energy prices and diversion of goods from China to the UK at cut prices is going to be a drag on inflation. But ultimately, the far bigger impact on the UK economy right now is the increase in costs from the national insurance tax increase and the minimum wage increases that have kept pay growth around 6-7%. And companies have narrow margins as a result of those costs on top of higher energy prices a year earlier. They are going to be looking to rebuild those margins. When we look at the survey data, we can see output prices, selling prices rising more quickly than I think is consistent with the Bank of England continuing to cut. So I think absolutely that's another sign that demand is strong, but we've got this cost push inflation coming through, and therefore inflation is likely to remain a bit higher than people think in the near term. And I think that does tie the Bank of England's hands. But the other thing is that I think we've learned now that interest rates at 4% does not undermine growth in the UK economy. The housing market is doing fine with interest rates there. So it's a story of kind of strong demand, or strongish demand, allowing price pressures to be passed through to prices, inflation higher, tying the Bank of England's hands for now. And then maybe when we do get a bit more of a tightening in fiscal policy next year, that's when we might see a couple of more interest rate cuts.
Where do you think you could be wrong here in terms of the outlook for this year?
Yeah, so it's very tricky at the moment because we do have this loosening in the labour market. And the problem is, in the 2010s, we always thought any loosening in the labour market was demand-driven, and therefore it's negative for prices, inflation as well. This loosening in the labour market is a response of firms to the cost of labour going up. So their demand for their goods and services could be absolutely fine. But even if that's the case, because labour is now more expensive, they're going to try and use less of it. So if the labour market decline remains modest, then it suggests it's mainly a supply shock. We shouldn't worry too much about a real downturn in growth. However, if a rise in unemployment starts to mean that people fear for their personal finances, their job security, and they really pull back in spending, then it is possible that we could get it turn into a demand shock that's bigger than supply shock, and that would be the situation where you would get a more serious downturn. But fortunately, we have the tools in the shape of interest rates that we can now lower significantly to deal with that if it comes to it.
Can you touch on the very difficult environment that central banks are now looking at? I mean, it was coming through in a lot of conversations with central bank governors recently that they're looking at one set of data. They know that the data could be moving in coming weeks and months, but they haven't seen it yet, so they can't respond in terms of monetary policy. How difficult is that for those that are typically known as doves and hawks and then having to really change their colours on the fly?
Yeah, absolutely. I think it comes back to this supply shocks that central bankers and I am banging on about. It is a different world, and it makes it more difficult because you can't say any drop in activity is definitely weaker demand. It could easily be these supply shocks. A supply shock is anything that raises input prices. So what does that mean? Well, because we don't know whether this activity slippage is due to demand or supply, it means central banks have to be reactive. And then that's even more difficult when we just don't have the detail we need on the labour market. And I say at the moment, particularly when we've got this increase in tax on employees, that increases the incentive even more for companies to employ people as freelancers, then maybe even that is not right, because we're not going to see the self-employment data for a long time that we can trust, at least. And it could be that we're just seeing people switching from employees to self-employed because of how the tax changes and changed incentives.
It does inject an element of uncertainty, doesn't it, when you think a policymaker is going to vote in a certain way and then they change their view because of some of the dynamics. I want to get into the trade around sterling dollar, because we have seen certainly a climbing currency in recent weeks as the dollar weakens, sterling's picked up along with other currencies. How much of that is bankable from here on out as we talk about the role that a firmer sterling will play with inflation?
Yeah, I mean, it adds to those sort of near-term downward pressures on inflation, that's right. But I do think that ultimately this underlying inflation is what the Bank of England is focused on. And, labour costs are the biggest component of firms' costs. And I think ultimately, although, a rise in sterling, lower energy prices are all going to flatten the peak in inflation in the second half of the year, it's still going to rise to a level that makes it difficult for the Bank of England to continue to cut. And I think actually what the UK economy really needs is a weaker pound. The fact that the government is pumping money in terms of deficit financing at the moment is as I've alluded to earlier, preventing those interest rate cuts, and that is hurting the export sector. So although domestic spending is strong, demand for the UK exports is weak because their price is ultimately uncompetitive in international markets, and that's not getting any better with the pounding as well as it has done recently.
Trade deals are plenty. Trump, India, one with the strange acronym out of Asia as well. Surely that's making a difference, or is it?
I mean, the big one will be next week with the EU, our main trading partner.
Hang on, the big one next week is about defence, it's about fishing rights, it's about my kids being able to travel to Europe and actually their kids being able to come over here as well.
Yeah.
And ECJ having rulings over UK law to a certain degree. Why is it the big one?
Yeah, so that last bit you mentioned, I think, alludes to dynamic alignment, which is basically what gives...
Which could screw us with other trade deals, couldn't it?
Maybe. Potentially, but I think ultimately we've got to remember which is, I suppose, our most important trading partner. And I think that what that does do is that overcomes the sort of uncertainty about market access into Europe and the cost of having to comply with two different sets of regulations for firms based here. And I think, the biggest sort of effect of Brexit on UK economy that we can see in the data is probably the incredibly weak business investment we've seen since 2016. And I think just certainty and drawing closer to Europe overcomes that, and that helps us with our biggest problem, which is productivity. In terms of India and US deals, I mean, the analysis tells you that they're both small, but again, particularly with India is a fast-growing economy. Over time, I think it could potentially be more helpful than the kind of meagre improvement in growth the official analysis suggests.
And the strange acronym, by the way, was CPTPP, which I think is designed to upset presenters and analysts alike. Thank you very much indeed for that. One thing I do know, that when we do get closer alignment with Europe next week, there is going to be a Daily Mail headline including the following words: Betrayal, Nigel, Kemi. Thank you, Andrew. They won't say thank you, Andrew. That's me. Andrew Wishart, who is senior UK economist at Berenberg. Come on, Daily Mail. Think of something new to say for a change on that front. Meanwhile, Russian President Vladimir Putin will not attend peace talks in Istanbul today, instead sending a delegation on his behalf. The Ukrainian President Volodymyr Zelensky had said he would not attend if Putin refused. After the Kremlin's announcement, US President Donald Trump said he will not be joining the talks, just days after hinting that he might.
Well, Qatar is the second stop of President Trump's tour out to Saudi Arabia, and he wasted no time getting down to business, signing a series of deals. Boeing and Qatar Airways announced a deal for up to 210 jets, Boeing's largest ever order of wide-body aircraft. The order includes 130 Dreamliners and 30 777-9s, with the options for the 50 more aircraft also in place. Now, the airline also signed a deal with GE Aerospace for more than 400 engines. Trump will now head to Abu Dhabi for the final leg of his tour. Dan is already there and joins us now. Dan, there's no doubt this trip for the president has come with lots of checks from the region. The Boeing one extraordinary, given the backlog of orders for Boeing and whether it can even fulfill these new orders from Qatar Airways. But just walk us through the significance as you see it from Trump's tour so far.
Obviously a really significant visit, Karen, and we've been following all of the major developments here. He is still in Qatar at the moment. He'll be arriving in the UAE later today. And importantly, in Qatar, in the coming hours, the president is going to be speaking to American troops who are serving on the largest American military base in the region after what was a really busy overnight stop in Qatar, where we saw this record-breaking Boeing deal to secure these 210 planes, but also the president taking the opportunity while he was on the ground in Doha to call on his Qatari counterpart to use Qatar's influence to try and get additional support for an Iran nuclear deal. So we're not just talking about the deal flow here. Finally, some diplomacy also starting to come into this conversation. Here's what President Trump said on the ground just a short time ago.
I hope you can help me with the Iran situation, because it's a perilous situation and we want to do the right thing. We want to do something that's going to save maybe millions of lives, because things like that get started and they get out of control. I've seen it over and over again. They go to war and things get out of control, and we're not going to let that happen.
The president will be arriving in the UAE later today, and he arrives as reports say the administration is finalizing what could be an agreement to allow the sale of some 500,000 NVIDIA AI chips to the UAE starting this year. Now, this move would, of course, be part of a broader strategy to deepen these tech alliances with the Gulf that we have been following through, of course, Saudi Arabia, Qatar, and into the UAE. The goal here is to boost the UAE's AI capabilities and infrastructure as well. In terms of the breakdown, the reports say we could see about 100,000 chips going to the Emirati tech firm G42, and then the remainder of those chips will be allocated to US companies operating in the region like Microsoft and Oracle, for example, which may also be planning major announcements here, including new investments or the opening of data centers in the UAE as well. Important to also point out here that the OpenAI CEO Sam Altman has been an interesting presence, an interesting figure alongside the president through the course of his travels this week. What we also know is that Mubadala's MGX, which is the UAE state-backed investment firm here, also has very close investment ties with OpenAI. So we're looking out for a potential announcement on that front as well. It's back over to you.
Dan, really appreciate the coverage. It's been fantastic all week. Now, coming up on the show, we'll take a look at the disparity between U.S. markets and their European counterparts. Plus, we'll be speaking to the CEO of the UK's largest technology company, Sage, as it extends its buyback and forecasts higher operating margins in the years ahead. Don't miss that CNBC exclusive with Steve Hare at 7:15 London time. And with earnings season in full swing, we'll be joined by another special guest, Helen von Roeder, the CFO of Merck, as the company cuts its outlook and strikes a cautious tone on the year ahead. Welcome back to Squawk Box Europe. Let's take a look at the market action in the U.S. yesterday. Another strong day for the tech sector. The Nasdaq up about 0.7% in yesterday's session. That was the 6th positive session in a row for the tech-heavy index. The Nasdaq is now up almost 7% on the week. We did see a little bit of red on the board with the Dow Jones pulling back by about 0.2%. Some interesting action in Treasury markets. I would suggest keeping an eye on the 10-year. The 10-year now trading at its highest level in a month, 4.5%, 4.55% this morning. We're currently around 4.53%. Now this, of course, despite the softer than expected inflation print this week. So the 10-year continuing to move higher despite that. Now in terms of European futures, what's in store for the European market open? We're about 40 minutes or so away from that. We've got red on the board across the major indices this morning. Yesterday, we did see the Stock 600 post its first loss in 5 sessions. We did see some big moves to the upside. Burberry, in particular, yesterday, that stock rising about double-digit in early trade after delivering a better-than-expected set of numbers.
Juliana, thank you. Let's get to some numbers. Sage has backed its full-year guidance after posting 9% of revenue growth in the first half of the year, in line with analyst expectations. Steve Hare joins us now, the CEO of Sage. Steve, I'm going to go straight to the technicals and flip the conversation. Normally I start with the macro, but I can see that the margins have stepped up, and I know that the market's going to be fascinated by these numbers. Now at 20.5% on the first half on the organic operating margin. Some are saying, previously you used to have very high margins in the 20s. Any chance you'll get back to those levels as you've made significant progress in recent times?
Yeah, well, I think we've said that we'll as we come out with our results every year, we'll add another 50, 100 basis points to the margin. But it's really important that we continue to invest in innovation. I think we're in a position from a technology point of view where we can really revolutionize small, medium business owners' lives with what we can do to automate their workflows, etc. So it's really important we continue to invest in that.
I want to get to some big changes in the landscape, because we've seen a step up in wages, minimum wages, national insurance contributions in the UK. The whole payroll landscape for a lot of employers has changed in recent months. How is that being reflected in what you're seeing, and what's the feedback been from a lot of those businesses?
Yeah, I think what it means is small, medium-sized businesses are very willing to invest in technology. They want to invest in technology. They want to invest in things which will give them their own efficiency, productivity and insights, so that they spend more time really focusing on running their businesses and finding ways to grow their businesses. I mean, small, mid-sized businesses face a number of headwinds, but they tend to be very optimistic people, so they just need a bit of help, and technology can give them that help.
Is the data giving you a sense that there's some pain point, though, from the higher taxes that some of these businesses are facing? Because the economic data we had today suggested that, look, the UK economy is in fine shape at this point, maybe distorted by tariffs for a few features, but is the data showing that there's actually underlying resilience in businesses?
I think small, medium-sized businesses always show a lot of resilience. I mean, look, last year in the UK, nearly 1 million new businesses were created, and that's a trend that has been prevalent ever since COVID. So people want to set up their own businesses, they want to do their own thing. The great thing about the UK is we tend to have consistency. So we decide to do things, and it doesn't really matter whether you like the tax increases. You know what they are, and then you figure out how to turn that into an opportunity. And that often means you need to invest in technology to make yourself more efficient.
What does that say about the cyclicality or lack of cyclicality of your business?
Yeah, so I mean, you need money in the economy, so you need people to be spending money, and you need activity. But there is often not a particularly good correlation with GDP growth, for example, because a lot of small businesses serve their local communities. And so as long as there's money, as long as there's activity happening, building's a good example. In this country, we talk a lot about planning, and we need to release planning, which of course is very true. But we also need more plumbers, more electricians, more builders, because we need to create the capacity to actually, to build things. You talk a lot about, or you talked a lot about the need to invest in your business, invest in the technology itself. Can you help us understand how you're using AI in your products, and maybe give us some, some color so we can picture how it actually works? I think so. It's going in phases. So the first thing to say about our industry is when we use AI to automate a workflow, it needs to be accurate. So a lot of a lot of the hype that gets talked about with AI, an AI hallucinating, we can't have that in our industry because, your taxes need to be correct. When you pay your customers, the amount needs to be correct. So the first phase is really automating those workflows. And it's the early stages of AI, for example, chasing an overdue customer. So creating an email and automatically chasing a customer and automatically telling you when that customer's paid. So it's almost like fetch and retrieve, and within that workflow, giving you insights. So as I say, telling you that the customer's paid. Now the next phase will be that those workflows will start to become more autonomous, because what the workflows today, the human is still guiding the machine. And over time, the machine will start to do more of that autonomously. The big benefit for the customer is it frees them up to focus on running their business and finding ways to grow their business instead of doing admin.
And yet, if you've got a government that is taxing workers more aggressively for those amazing SMEs, and by the way, I concur 100% what you're saying about we need more plumbers, carpenters, electricians, rather than more coders, because most people out there aren't going to be good enough at coding to ever contribute to AI, but that's perhaps diverting. But you made some comments after the November budget, and I think, so government policy towards the extra costs on employees, plus this surge in AI, it's going to mean less workers, isn't it, rather than more in these areas?
Yeah, I mean, at the moment, when I talk to small, mid-sized businesses, they all still say that they're struggling to hire the people they need with the skills they need. So I think it goes
at the price they want to hire now.
But I think if we go back to it's the availability of skills, and often when people talk about skills, they talk about, we haven't got enough, data scientists, we haven't got enough computer engineers, etc. And of course, for people like Sage, that's partly true. We do have to work hard to find those people, but it's people doing the real jobs out there in the economy. And whenever I'm lobbying government, I always say, look, if you take money out of the economy, i.e. you tax, you need to put it back in. So if you're investing in infrastructure and you're enabling more economic activity, then it can work. But if you're taking money out and you're spending it in other ways, just putting it back into public services that's not driving the economy, then that's not great.
Well, and you and I have got a massive advantage over Karen and Juliana.
Tell us.
You two can't find a plumber in central London. He can in Yorkshire, and I can in East Sussex. Because you guys, and you're going to pay 3 times the price that Steve and I are going to pay, because we live in the countryside, and no tradesman worth their salt wants to travel up to London with all the hassle involved. That's another point. You're also a non-exec at Sainsbury's as well, and so you have a brilliant barometer on from the SME up to the biggest companies, and I'm going to put a regional bias in this one as well, because every government of the last 10 years, the blue variety and this variety as well, talking about the redressing the balance of the economy, getting the northern infrastructure working. We spoke to Jim O'Neill, who's such a great, passionate guy about this from his southwest London home. If he's watching, he's a proud Mancunian, I know that. But in terms of what this government is doing, the good and the bad, what do you think, Steve?
Yeah, so I think the plan, if you look at the industrial strategy that they published, there's a lot of really fantastic stuff in there. And so whenever I'm interacting with government, I would say, look, the good is your intent's there. You're talking about growth. You've published stuff which, if you implement, will drive growth in the economy. I just wish we would get on with it and do it faster, because we need to get to the outcomes that are in that. We need to turn that intent into outcomes, and we need to do it all across the country. And that's harder than it looks, but we need to make it happen. We need some scores on the doors.